Morning. Morning, everyone. Maybe just to say we were quite happy when Justin invited us back this year. We had the privilege of presenting at the previous summit, and those that were here will know that it was quite a rough picture. So we thought maybe we never get invited back after that. But if you look back over the past few years, I think it's safe to say if there's one industry that knows something about navigating turbulent waters, it's this one. I think it's been well proven to that extent. We were asked to present our outlook for the sector, so I think we will touch on many of the aspects that have been talked about before. Many of them have been talked about, many of them will still be talked about. What we'll try and do is relate those a little bit to Rand and Cent. What is the impact on your bottom line, and also to the way we see the industry going forward. To what extent do we think they will remain? To what extent do we think they will change again? And how does that influence the outlook for the citrus industry in particular? So we'll start just with some basic info, some of the things that are still the same compared to the last time when we spoke to you. Obviously a very important industry within South African agriculture, so citrus is the fifth biggest industry in terms of gross production value, 7% contribution. If you look on the trade side, that ramps up quite significantly. So it's obviously the biggest agricultural exporter, I'm sure you're well aware. $1.8 billion in 2024. That's 12% of the total agriculture food trade. So that's a massive contribution. Employs in excess of 140,000 people. That's 15% of total agricultural employment, as noted in the latest Stats SA numbers. And then just to say that it's an industry that's obviously undergone some changes in recent years. So I think the last time we were here, we were coming out of a strong expansionary cycle that's slowed significantly. And we can probably say that there has been some rebalancing of supply and demand over the past few years within this market, both internationally and in South Africa. So Southern Hemisphere production was down. Maybe that's an external factor that helped a little bit that we can appreciate. But also South Africa's export volumes were down in 2024 for the first time in many, many years. And the result is that from 22, which was the last time we were here, to 2024, we've seen a 22% increase in prices. So that obviously has made a significant difference. Some of that is due to actions taken. If you just look at expansions, so there we're showing it in terms of budwood sales, which is obviously your leading indicator. You can see that a few years back, you were adding 6-7 million per year. Now we're at around 2.5. So that has slowed significantly. If you look just from 2021 to 2023, that's almost 60% reduction. But also on the demand side, if you just look globally at inflation numbers, 2022, we just started the war. That was prices of commodities were ramping up, shipping rates were ramping up. Energy costs were ramping up. So, in Europe, inflation peaked at 9.3%, at a global level, 8.6%. So this has a massive impact on spending power in those markets. Europe's come down nicely to 2.6 already, and the world is lagging a little bit. It's mostly due to developing economies. But we are trending in the right direction. So the market space is also recovering a little bit. And then, of course, freight rates. So those also peaked in 2022 at probably say ridiculous levels. It's probably a safe comment. But those have also come down 23% in the last 2 years. So we're still well above where we were. We're still about 33% above sort of pre-disruption world. But all of this is starting to look a little bit better. And then, of course, the question is, what is the impact of that in terms of your bottom line? So what we've got on screen, we've just got in blue revenue stacked from the different sources. So exports obviously being the big one, and then local markets and processing. On the right-hand side, production. So you can see there nicely the trend up in revenue in the last 2 years. That's prices working for you. But also note the contribution of the processing side in 2024, which obviously was also a big help. But also costs trending downwards. So both sides of this equation moving in the right direction. And then the impact of that, of course, is that this is just stated in gross margin terms, so it's not your final income. But you can see, if you compare 2022, where there was hardly anything, the last 2 years have certainly been a lot better. And I think the general sentiment in the sector also reflects that. So this is just an industry average view. As any economist, I wouldn't be complete if I didn't have a caveat associated with that. So I just tell you that we do acknowledge that nobody's farm probably looks like that one. It's just indicative, so it's designed to show you the movements over time in the industry. This is some data provided by colleagues from Source BI, so just a shout out to them. We do appreciate also sharing the information and helping on this front. But just shows you the difference between the different commodities, the different areas. So there's a lot of variation there. We acknowledge that, and when we do the detailed analysis, we do certainly consider that, and we express the different regions. But much of what I'll show today is very much focused just on that industry average to give you sort of a general idea of where things are moving and why we think they're moving in that direction. So if we start to look forward then, I think, if you look at that picture we find ourselves in, some of those factors are actions that we took. Some of those factors are just exogenous factors that changed and improved for the better. So the question then becomes, what does that imply for the baseline? Our sort of business as usual outlook view, where do we see the sector going as a result of that? But also, what are the risks that remain? What should we be looking out for? Are there new ones on the horizon? Which ones have been solved? Which ones are still around? And also, are there additional opportunities that we can unlock? Even though we are looking a bit better, can we still accelerate and improve even more than what the baseline view is? So it's been said a lot over the last 2 days that we live in a very uncertain world. I will say it again because I think you probably can't hear it enough. The environment is obviously very, very complex, and to do an outlook, to look into the future of where you think an industry will go, obviously these are all factors that you need to consider. So from a global growth perspective, the latest World Economic Outlook from the IMF is at 3.3% for this year. That's very similar to what we had in 2024, but some divergence within countries. So they've upgraded the US a little bit, they've downgraded Europe, they've downgraded China. So there are some dynamics within that that are worth taking note of. They also note in the report that there's ample downside risk, and if you read it, there's not a lot about upside potential. There's quite a lot about downside risk. So it is still a little bit of a caution environment with respect to demand. Inflation, as I said earlier, has declined nicely, but we've seen a lot faster convergence to sort of target levels in the developed world relative to developing areas. In many of these developing regions, there's some, uncertainty brings currency devaluation, and that drives inflation, and then you sort of trade off on the policy front between protecting the currency and initiating growth. So that has slowed things a little bit. We've seen a lot of changes in government. I think half the world had elections last year, or more than half the world, and quite a few of them had changes, including ourselves. But of course, the big ones, we had changes in the UK, we had the big change in the US. So there's significant policy uncertainty associated with that. Geopolitical tensions, fragmentation in the trade environment, all of that remains. I think probably given changes in government and in that policy space, probably in many extents accelerated and looking even more complex than what they were a year ago. But this is something that's been coming for some time. And of course, for us specifically, there's uncertainty around AGOA. There's the whole environment with so-called Trump tariffs on the rest of the world, what that implies for us and where does that go in the future. But it's also worth remembering that sustainability is also still on the agenda, maybe not for President Trump, but for many others. I think it's not gone away. Maybe it's softened a little bit, but it's definitely still in that policy space. It's something worth watching out for. There's a cost of compliance associated with that. There are often market access implications, and there is often questions about productivity. If you drive it too far, what are the impacts on productivity in those countries? South Africa's environment also increasingly complex. I think, initially when the GNU was established, there was a lot of positive sentiment. I would say it's not completely gone, but of course there have been some challenges. At least we had the budget yesterday on second attempt, so we are moving in the right direction. But broadly, it's looking a little bit better, but we still need to accelerate growth substantially, if we're honest, from the levels that are currently being projected, specifically in the short term. And of course, there's a lot of structural challenges, which this industry is well aware of, that inhibit us a little bit in terms of competitiveness. If you think municipal service delivery, water, electricity, ports, logistics, general road, rail infrastructure. There's a lot of factors that need attention, and a lot of them are starting to move in the right direction, but a lot of them also still require time to really get to the level where we want to be. So if we do the outlook on many of these factors in this uncertain world, we have to make some assumptions. So this is just some background on what we consider for the baseline. That's the exchange rate. Of course, that influences across your chain. We've put it there with marketing because it does influence your price, particularly in the export market. But it does also influence the rest. So we're at 1830 for 2024, a little bit of a depreciation in the sort of medium term, and then a bit of an accelerated depreciating trend going forward. That, of course, influences the input side, so you'll see a very similar trend if you look at something like fuel costs, very reflective of that exchange rate trend as well. Labor, a little bit dissociated from that, so that's obviously linked more to general inflation, typically a little bit inflation plus. And then if you look on the fertilizer side, again, very similar trend to what you see on the exchange rate side. So these are the core assumptions. And then I'll give you the baseline outlook in one slide because there's all these uncertainties I have to get to. So generally speaking, we expect area to stabilize. As I said earlier, we've come out of a period of rapid expansion that has slowed quite significantly already. What you see on screen are average annual growth rates for the different products over the past 5 years and then projected for the 10-year period. So if you were to do the past 10 years, that would be quite significantly quicker than what you see in that past 5 years. But still, if you look at mandarins, still quite positive, lemons, the outlook is very, very flat. So you see a small negative there. I mean, it's a little bit of a trend within that, but it's basically stable in terms of area. That doesn't mean that we're not establishing new orchards. We are in a much closer to sort of a normal replacement cycle than what we would have had a few years back. We also do still see productivity gains coming out. So as people replace, as technology improves, we do see some productivity gains over the outlook, and particularly in the case of mandarins, which is the only one now which is sort of where the share of non-bearing trees is still more than what you would find in a sort of normal replacement cycle. We'd also see the impact of some young trees entering the system there. Price-wise, I'll show you the prices over time in the next slide. But this is just, again, a summary. So this is in real terms. So we've removed inflation from this. So if it's negative, it means it's not growing faster than inflation. It's not meaning that it's coming down in nominal terms. You'll see the better picture in the next one. But broadly, that holds for all commodities, right? So some of them a little bit faster than others. You know, something like lemons, we've seen significant decline already. Something like oranges, we saw quite a bit of recovery in the last 2 years with the situation in Brazil. But broadly speaking, we don't expect prices to grow faster than inflation for most of the coming decade. And if I just put that over time to give you some context, this is export volumes. So we've got the bars showing export volumes over time. That's on the right axis. And then we've got the line showing you export prices, right? So you can see, I think it's quite clear, the recovery in the last 2 years. Oranges, we expect that to last a little bit because we do think that while Brazil's moving in the right direction, it probably takes a few years. It's not something that's going to be solved next year. So those prices hold a little bit, and I think, you know, the viability of that processing market was one factor amongst others, you know, the port situation, weather conditions, etc., that resulted in lower export volumes in that sector in the last few years. We do still see recovery, as you saw from that production growth, so that has to go somewhere, and most of it goes into exports. So we do still see export volumes rising. The ones where it's probably the fastest is mandarins, and that's why you see some price pressure in the short term as those volumes continue to come in. Lemons have stabilized quite significantly, and then, yeah, obviously grapefruits, which is quite a cyclical thing. But for all of them, we do expect additional volumes to come into the market, and in the long term, you know, medium term, that does still present some price pressure going forward. Our outlook, I would say, is probably still, we were trying to think how we would describe it in one sentence. It's still suboptimal, if I can call it that. So we don't, for instance, by 2034, we're still 23 million cartons below your Vision 2060. So that's saying we're not unlocking, you know, we rely on this on our economic model. So this is producers making decisions in response to this profitability situation. And that doesn't quite get us to the Vision 2060. So we acknowledge there is that potential, but we need to close that gap, right? So that's what we're working with here. The last one on the baseline is just related to profitability. So this is my colleague Candace's numbers. Again, we're just looking at an industry average, but some of the assumptions for 2014, we got export prices at just over 200 Rand a carton, cartons per hectare around 2,000, your yield 52, you can see the costs there. The implication, if you put that in terms of profitability, you can see much better than what we had in 2022, at least we don't hit into the negative. This is the average outcome, right? So this is your baseline position. So declining in the short term as those prices come down, and then as they recover in nominal terms, we do see that going up a little bit again. You have to remember that there's still inflation included in these numbers. The last step is also just to look at the risk profile. So if we take some key variables, what we did here, we looked at yields, pack-out percentages, export prices, local prices. We look how much volatility there was historically around the average, and we impose that volatility going forward around the average projection. We run it 500 times, and we get a probability distribution of the outcome. So 15% of that times that landed in the negative. This is on average over the 10-year period. 25% positive, but less than what typical finance costs would be. 42% in the green, and 18% properly in the green. Giving what would be considered a good return, given investment costs, etc. So then the question becomes, why are we still suboptimal? Why are we not getting to those Vision 2060 numbers? And I think there's three things that we identified here. Firstly, the trade environment. So there you have the big markets for South Africa. I think it's quite a cool picture. It shows how diversified we are, where all our products go. You've got them in order of magnitude. And then you've got the tariffs in those going into those specific markets. So I won't run through all of them. Some ones that we probably want to highlight, firstly, the EU. So we know here we've got preferential access tariff-wise, but obviously strong non-tariff measures. So we've got massive costs with respect to CBS, FCM, managing those products. Second one is the US. We know there are challenges there. So obviously, from a non-tariff perspective, it's only your CBS free fruit that enter that market. Total volumes, it's roughly 4% of our total exports, but in those areas that can export there, Western Cape, Northern Cape, we're looking at 20%, so it's not insignificant. I think much has been said about AGOA. What is the impact? How restrictive is it if we lose it? I think it's been said before, for those that export there, the impact is significant. For the bigger economy, maybe it's a little bit less. I think what one needs to highlight here is, firstly, it depends what the alternative is. Do we go to most favored nation tariffs, which would normally be expected? Those are not so high, so it's probably still possible. Maybe we're a little bit less competitive, but we can still trade. Or do we go to a blanket 25% or 50% like President Trump has imposed on some other countries? Then it becomes a lot more serious. If those volumes come out of the US, they have to go somewhere else. So then it starts to impact also the other regions that don't export to the US. Last one is BRICS. So they're obviously a growing market for us. We have good relationships with these countries. We also saw that yesterday. But in many of them, we do still face quite significant tariffs. So I think there's a lot of work to be done for us to get a more beneficial tariff picture in these countries, as we have with some of our existing trade partners, such as the EU. Quick word on Africa. So if we add all of Africa and consider it as one country, like many of our international colleagues do, that would be about 10th, right, Candace, that we land. So 2.5% of our total trade. So it's not a big market. I think a lot is often said about the Continental Free Trade Agreement. But of course, there are still limitations in terms of infrastructure, spending power, so forth, in trading products into those markets. The other that we wanted to note is policy. So we heard yesterday that the Green Deal is dead. I was pleased to hear that. It's obviously had very specific targets with respect to pesticide use and so forth. These are now off the table if we consider it dead, but the reality is that the focus on reducing these things still remains. It's got a new name, it's still saying very much the same thing. And increasingly, there's this focus on competitiveness and making sure that trade partners comply to the same standard, which would say that your MRLs and those sort of things all get adjusted to come in line with this. So this is not going away, even though the name has changed and we've entered a new cycle of negotiations there. This is from work that we did in a recent study. Candace put the link there on the slide, so you can click on it afterwards and read it. It's a whole presentation to do just that. But what you see on screen is just your PPPs that have lost approval in recent years. So that's on the left-hand side of the orange line. And then the ones that are coming up for approval in the next few years. So there's a lot of them that could potentially be lost. Okay, so we don't know obviously the outcome of many of these, but I think it's safe to say that we won't maintain the use of all of them in the EU. Of course, that then has implications for us. What can we use here? The pest prevalence doesn't go away. It's still something that we need to deal with. So the question becomes, what alternatives do we have? What do they cost? How efficient are they? Is there an impact on our yields? Is there impact on our pack-out percentages in terms of quality? How much more do we have to pay to use the alternative? So there's a lot of uncertainty in the space. It was interesting when we did the work also, sometimes you have responses in one region that loses a product that has price implications that sometimes make other regions that don't have such a big pest prevalence better off and that region worse off. So there's quite a lot of dynamics within that analysis that you're welcome to look at. I think the study is on our website. Alternatively, we can also send it to you. The other one then is logistics. So this is the third one of the three that we looked at. There you've got our classic export corridors, the blue one in the north, Eastern Cape and Western Cape. And if you just look over time, our inspections for 2024, that was just over 160 million cartons. That ran pretty smoothly. There was one glitch in the middle there, or almost in the middle, which was weather conditions locally and just a bit of an overstock market in the EU, which put the brakes on a little bit. But that's a fairly smooth picture. I think then there's a lot of things don't always move in these corridors. Sometimes we have to go to different ports, to go to different markets, etc. So there's that dynamic that we need to keep in mind. But also, if you overlay the actual export movements over that, I won't repeat the words that I used when we first looked at this picture, but that's quite a mess. And that's this excessive volatility, this being delayed, catching up, all of that has implications. There are costs involved. Sometimes you have to redirect markets, so you have products needing to go somewhere else. I don't have to tell this crowd that comes with a significant additional cost. So in the work that we did recently to try and quantify that cost, we thought about it in three ways, essentially. So there's direct costs. This is our shipping rates that are higher because it's become the norm to have delays in many of our ports. It's trucking to go to a port that's not necessarily the most efficient one for you to go to. It's repackaging costs if things get delayed and they have to be repackaged in destination market. If you add all of those, we look at about 10 Rand a carton, so that's 1.6 billion to the industry as a whole. Indirect costs, price fluctuations. When you see that graph doing this, when you have not enough product and then you're catching up and you're pushing a lot of product, that pushes the price down in that market. So there's price implications there. There's quality claims if delays were too much. There's rerouting costs if that's the direction that you need to go. So all of that added up to around 16 Rand a carton. And then costs of products that go unsold, which for lack of a better word, that's the best we could come up with. But obviously when you're repacking, some of that then doesn't make the cut, right? So you're losing product. When your chain is too delayed, your pack house isn't optimal, you may be picking a little bit later because you're pushing back on delays, and all of that has an implication as well. So that came to around 7 Rand a carton. So you can see that's a massive impact for the industry as a whole in terms of the cost of our port inefficiencies. So the last one, I have 5 minutes left, is how do we unlock this potential? So what can we do? We say we're falling short in the baseline. There's a lot of risks that we're facing that sits behind that. But what can we do to actually try and get there? So for that, we looked just a simple approach at some study group information. We looked at our top performers and how they differ from your sort of industry average. In terms of output, on average, yields 14% higher, pack-out percentage 12% higher. It's around 540 cartons per hectare that you're exporting more in your top third of those groups relative to the general average. So of course that has implications. Normally, from a cost side, that implies more cost per hectare, 4,500 Rand on average for your fertilizer and chemicals. But because you've got these yield and pack out benefits, you're actually less per ton and even more less on a per export carton basis. So those are your efficiency gains working for you. And then, of course, salaries and wages as well. You're paying more because you've got more volumes that you need to move. But on a per ton basis, a per export carton basis, that then gets significantly less. And then, of course, finance charges, that's quite a significant chunk of your total income at the end of the day that's going to that. So if you can generally be better off and you can alter your strategies there, maybe you can also come down a little bit in terms of your total costs. So this is just looking purely at if we can get the efficiency gains on farm, where obviously we can control what we're working with. What does that give us? And then the other side is if we look at the rest of the chain, what can that give us if we're more efficient in the rest of the chain? So here we've got road to rail, so in the northern corridor, if we can get off the trucks and onto railroad, that's around R5 a carton. That's 25% saving on that transport component. That's quite significant. If we can stick to a single cold chain storage cycle, so if we don't have to go longer than what we need to because we're accommodating delays all the time, that's almost R1 a carton saving on average. If we look at the additional costs from a shipping perspective, because of these frequent delays, that's almost R4 a carton on average. And if we look at the price fluctuations because of this irregularity in arrivals that we showed there, that's almost 50 euro cents a carton. So that's almost 10 Rand a carton that you're looking at. So all of this adds up, right? So if you bring that back to a profitability perspective, here we've got sort of the value chain costs laid out for you in the current state. So as we're currently operating, what does that look like in 2024? So you can see the prices there, the revenue in FOB and DIP terms. Farm gate price, 119 Rand per carton. If you can fix a few things, as per the previous two slides, this gets us quite significant gains. So if we just look at the efficiency gains in the chain, that's around 10 Rand that we can save. So that gets us to 129 at farm gate instead of 119. And then if we can get those yield gains and the additional export cartons per hectare on farm, that gives us some additional savings as well. So if you look at a net farm income at the end of the day, you're more than 20 Rand better off in that environment than what you were previously. So if you add that up, total Rand per hectare, we're looking almost double. So it seems like small gains when you do all the individual components, but it can make a massive difference if you roll all of this up into your final bottom line. So the last side of this is risk, exactly the same as what I explained earlier. So this is the over time picture of the numbers that you saw right in the beginning, the risk distribution. Under the baseline, again, showing negative, less than finance charges is in yellow, profitable and well profitable, for lack of a better word. If you make the farm level improvements, that's how your distribution changes. So you can see it's quite significant gains, particularly on the light green aspect, also the dark green. So a lot of them moving into a much more profitable situation from the profitable one. Value chain improvements, very much the same. So this is just farm level versus just value chain. And if you put them together, then that's the picture you really like to see. So then you get huge reduction on that red and yellow space and significant improvements on the green side. So I've been shown the time is up, but I still have 30 seconds on here, so I got my last slide. Just to say that I'll leave you with this thought. We're trying to coin the phrase at BFAP that agriculture is more than just agriculture. So at the beginning, I showed you the share of citrus within primary agriculture. That's your 7% on GPV. We went to make the calculation to look at the entire value chain. If we look at inputs, your processing side, your trade services, your backup services like research services, etc., that gets to 14%. So in actual fact, and this is your communication tool, if you can unlock this potential, if you really can get to this vision 260, the impact's actually much wider than what you think. You're talking about a share of the 14% of the economy, not a share of the 3% of the economy.